Investors aren't recoiling at the sight of Australia's mining tax. It's small beer in the context of the Northern Hemisphere's debt crisis, and it could be small beer for the government as well. Critics say the government won't raise enough money to fund its promises, and the tax take is hostage to the uncertainty of exchange rates and resource prices. Here's Philip Lasker.
Shoveling dirt and shipping it offshore may look simple, but there's nothing simple about the politics and economics of taxing it.
It's certainly been messy. The tax is, I guess, at best ill-designed.
The watered-down mining tax or mining resource rent tax is a shadow of the comprehensive proposal put forward by the Henry Tax Review. It taxes coal, iron ore, gas and petroleum, but not minerals or metals like copper or booming gold.
I think over time we will see interest in expanding or broadening the mining resource rent tax.
According to John Robinson, the broadening will occur out of necessity rather than choice, because this revised tax won't make cash cows out of the giant miners.
It positions the major companies, the BHPs and the Rios, in a fairly good position in as much as they're able to rejig their depreciation base back to market value. In other words, start all over again in terms of the depreciation base they use. And this means that they're going to have some fairly major offsets to the tax, particularly in the early years.
And as for the government's expectation that the tax will raise $11.1 billion in the first 3 years...
We know from looking at past budgets that revenue estimates are often out by something of the order of plus or minus 10 billion or more. So that's a very, very small thing in the scheme of things, I think.
But it's enough to raise doubts about the government's ability to fund its mining tax-linked spending promises, like interest income discounts, a 1% cut in company tax, and the gradual increase in compulsory super from 9 to 12% of salaries.
The kindest thing you could say is that it's heroic. And the concern, obviously, that flows from that is that once the shortfall in tax take becomes evident over time, given that the spend side is already committed, there's going to have to be further pain for somebody.
As if to underline the resource sector's vulnerability in the face of the government's optimism, a survey showed Chinese factory activity was the weakest in nearly 3 years.
There's obviously a lot of variables that will impact on the final take, not least of which is the commodity pricing and exchange rate.
Both would be undermined by a significant slowdown in China.